5 years. That is how far back you have to go to find COMEX silver inventory this low. And at the exact same moment those warehouse numbers are hitting a 5-year floor, Shanghai is paying $4.72 more per ounce than the Western paper price. Two completely separate data sources, two completely independent signals, both pointing in the same direction at the same time. That is not noise. That is a setup worth understanding, and that is exactly what we are doing today. Last week I told you to watch the Shanghai premium specifically, whether it held above 5% as the key confirmation that Eastern physical demand was structural rather than speculative. Here is what happened. It held. The Shanghai Gold Exchange silver price came in at $88.45 this week against a COMEX spot price of $83.73. That is a $4.72 gap. That is 5.63%. The call was valid and the premium not only held, it is now combining with the inventory data in a way that changes the conversation entirely. John here, FX insider, 15 years in currency and commodity markets before I ever picked up a camera. Everything I tell you comes from that experience, and everything is backed by data you can find yourself. I have watched silver move before. I have watched squeezes develop and fail and develop again, and I have learned that the setups worth paying attention to are never the ones the headlines are shouting about. They are the ones where 2 or 3 quiet data points start saying the same thing at the same time. That is what is happening right now. Everything I show you today comes from publicly available sources, and I will name everyone as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Here is what you are going to understand clearly by the end of this video. 1. What 5-year low COMEX inventory actually means in mechanical terms, and why it matters more than the spot price right now. 2. How the $4.72 Shanghai premium and the inventory drain are connected, and why that connection is the most important thing in this market this week. 3. How to use the 3 lanes framework to read whether this squeeze setup is real or whether it is a paper story that dissolves under pressure. Stay with me, because around the 8-minute mark, I am going to show you something in the Bloomberg industrial demand data that most channels covering this story have walked straight past, and it reframes everything. Silver spot is at $83.73 right now. COMEX front-month futures are at $84.25. That small gap between spot and futures is normal. It reflects carry costs and near-term positioning. What is not normal is what sits underneath both of those numbers. COMEX registered an eligible silver inventory, the physical metal that is actually available to back futures contracts and meet delivery obligations, is at its lowest level in 5 years according to the CME warehouse report. If you are holding silver in a SIPP in the UK or a silver IRA in the US right now, that number matters to you directly, not because anything breaks tomorrow morning, but because the buffer between the paper promise and the physical reality just got significantly thinner. And that changes the risk profile of this market in ways that take time to play out, but are worth understanding now rather than after the fact. Let me explain what COMEX inventory actually means, because this is where I want to spend real time with you and where most coverage gets lazy. COMEX is a futures exchange. When you buy a silver futures contract, you are buying a paper claim on silver that may or may not result in physical delivery. Most contracts never go to delivery. They get rolled or settled in cash. That is normal, and it works fine as long as there is enough registered inventory in COMEX-approved warehouses to satisfy the minority of contracts that do demand physical metal. Think of it like a bank. The bank does not hold $1 of cash for every dollar on deposit. It holds a fraction, enough to cover normal withdrawal demand. That works perfectly until withdrawal demand becomes abnormal. COMEX registered silver inventory is the cash in that vault. And right now, that cash is at a 5-year low. Here is the number that stopped me when I pulled up the CME warehouse report this week. Registered silver inventory, the metal that is actually available for immediate delivery against futures contracts, has dropped to levels not seen since 2019. Now here is why that specific detail matters. It is not just that inventory is low. It is that inventory is low at the exact same moment a buyer 4,000 miles away in Shanghai is willing to pay $4.72 more per ounce than the Western price. When that premium exists, it creates an economic incentive to take physical delivery from COMEX and ship that metal east. Every ounce that moves from a COMEX warehouse to satisfy Eastern demand makes the registered inventory number smaller, and a smaller inventory number means the buffer gets thinner. And a thinner buffer means the next demand spike hits a system with less room to absorb it. I want to be straightforward with you about something here before I go further, because this is where I have to be careful, and where most channels are not. A 5-year inventory low sounds alarming, and the Shanghai premium sounds alarming. But low inventory plus high premium does not automatically equal a squeeze next Tuesday. What it means is that the conditions for a squeeze are assembling. The mechanism is real. The data supports it. But the timing of when or whether those conditions actually trigger a forced short covering event is not something any honest analyst can tell you with precision. What I can tell you is what the setup looks like right now and what specific threshold to watch for. That is the job. If you know someone who has been trying to understand why silver keeps trading below what the physical demand data seems to justify, share this video with them right now. The inventory and premium story together is the explanation. This breakdown took real time to build, and the people who need it most are probably not searching for it. Now let me bring in the demand side of this equation, because the inventory story is only half the picture, and the other half is where Bloomberg's reporting this week adds serious weight. According to Bloomberg's commodity analysis published this week, industrial silver demand from solar photovoltaic manufacturing and electric vehicle production has now exceeded available supply on a sustained basis. That is not a projection. That is a current condition. The Silver Institute's annual data has been documenting consecutive years of structural silver deficits, meaning total demand across industrial, investment, and jewelry categories consistently exceeds total mine supply and recycling. Bloomberg's reporting this week aligns with that structural picture and adds the specific industrial categories driving it. Solar panels require silver paste for electrical conductivity. That is not a substitutable input at current technology levels. Manufacturers cannot simply swap it out when prices rise. EV battery management systems and charging infrastructure both have silver content requirements. And the scale of global solar installation and EV adoption that governments in the US, UK, Europe, and China are mandating is not a short-term trend. It is a decade-long industrial commitment measured in gigawatts and millions of vehicles. Here is an analogy that makes this real. Imagine a pipe supplying water to a growing town. The town keeps adding houses, solar farms, EV factories, electronics manufacturers, each one adding demand to that pipe. The pipe was built for a smaller town. It has not been meaningfully widened. Mine supply growth has been modest, and new silver mines take years from discovery to production. So the gap between what the pipe can deliver and what the town now needs keeps widening. The Shanghai premium is what happens when one part of that town, the Eastern industrial and investment buyers, decides it cannot wait for the pipe to catch up and starts paying extra to get water brought in by truck. That is the $4.72 premium in physical terms. And those trucks, the arbitrage flows pulling metal from COMEX toward Shanghai, are why registered inventory is falling. From a UK perspective, this matters in a specific and practical way right now. The UK government's commitment to North Sea offshore wind expansion and domestic solar rollout is not an abstraction. It is contracted capacity with real silver content requirements embedded in every panel and every electrical connection. UK investors watching the Royal Mint's monthly silver coin and bar sales data have already seen elevated demand figures in recent months. British buyers holding silver inside CIPPs are sitting inside the same structural supply picture as their American counterparts. The LBMA silver benchmark this week is reflecting the same Eastern premium pressure that is showing up in COMEX data. This is not a US story. It is a global physical silver story with British implications. The geopolitical and monetary layer adds further context without turning this into a doom narrative. And that distinction matters to me. Central banks globally have been diversifying reserves away from pure dollar holdings, according to the World Gold Council's most recent survey. That process does not directly buy silver at the central bank level. Gold is the reserve asset of choice, but it does reflect a broader institutional shift in how sovereign wealth is being managed. And that shift creates a macro environment where alternative stores of value attract more serious attention from retail and institutional investors simultaneously. The CBO's latest long-term budget projections continue to show a U.S. structural deficit trajectory that historically has been one of the slow-burning tailwinds for hard assets generally. I am not saying the dollar collapses. I am saying the math keeps compounding, and the people running large pools of capital are doing the same math. De-dollarization is a decade-long structural process It is not a Tuesday event, but the direction of travel is visible and documented, and silver sits inside that story as the more accessible, more industrially grounded, more volatility-exposed version of the hard asset trade. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, the blue lane. COMEX silver futures at $84.25, spot at $83.73. Futures open interest, I want you to watch this number specifically, has been showing the kind of contraction that historically precedes either a short squeeze or a positioning reset. The CME warehouse report is the source on this, and it is updated every business day. Lane 2 is the physical market, the silver lane. This is where the story is loudest this week. COMEX registered inventory at a 5-year low per the CME warehouse data. Shanghai Gold Exchange silver at $88.45, a $4.72 premium over Western spot pricing per SGE published data. Both of those numbers in the same week in the same direction is the physical signal I have been watching for. Lane 3 is the macro lane, the gold lane. The US dollar is the key variable here. The article flags that if the dollar index crosses 102, metals face additional headwind pressure. The DXY is currently trading in a range that bears watching. Dollar strength at that level historically compresses silver more than gold because silver's industrial identity makes it more sensitive to growth expectations than gold's pure monetary identity. In 15 years watching currency and commodity markets, the times I have seen physical inventory at multi-year lows combined with a sustained Eastern premium above $4. Those have been some of the most structurally significant setups in silver markets. I am not saying a squeeze is guaranteed. I am saying this combination of signals is historically rare and historically meaningful. When the paper lane shows open interest contraction, the physical lane shows 5-year low inventory and a live Eastern premium, and macro is holding below the dollar danger zone. The historical pattern has leaned towards silver price resolution to the upside rather than the downside. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The $85 level on COMEX silver futures. Not because it is a magic number, but because the article and the positioning data both identify it as the threshold where algorithmic and systematic short positions are clustered. If COMEX silver futures break and close above $85 on meaningful volume, the data suggests that triggers a cascade of short covering. Traders who are short silver being forced to buy back their positions to limit losses, which itself pushes price higher, which forces more short covering. That self-reinforcing dynamic is what a squeeze looks like in mechanical terms. I will be watching the CME daily settlement price every session this week. If 85 breaks on volume, that is the signal. If it does not, the floor holds and we wait for the next catalyst. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. COMEX futures break above $85 on genuine volume, triggering the short covering cascade I just described. The Shanghai premium holds above $4, confirming Eastern physical demand is not retreating. COMEX registered inventory continues to decline, showing the arbitrage drain is active and ongoing. The dollar index stays below 102, keeping the macro headwind manageable. If those 4 conditions develop together over the next 2 to 3 weeks, the squeeze setup the data is pointing toward becomes structurally supported, and the price picture changes materially. Here is what needs to happen for the cautious picture instead. The dollar index pushes above 102, adding genuine macro headwind to silver specifically because of its industrial sensitivity. The Shanghai premium compresses back toward $2 or below, telling us Eastern demand was a temporary spike rather than structural. COMEX registered inventory stabilizes or recovers, removing the delivery pressure from the equation. In that scenario, silver likely retraces back toward the $78 to $80 area without that representing any fundamental breakdown in the longer-term supply story. Both outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right numbers. Before the 2 questions, if you got value from this today, The like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding physical silver? And if so, are you watching the $85 COMEX level as a trigger, or are you focused on a different signal entirely? Whether you are in the US or the UK, drop that in the comments right now. This comment section becomes a real-time sentiment tracker, and I read every single one. Second, looking at the 3 lanes framework. I just walked you through, do you think the physical lane signal, 5-year low inventory plus the Shanghai premium, is strong enough to overcome a dollar headwind if the DXY pushes toward 102? Tell me your read below, subscribe, because next week we are going deep into exactly how to read the CME Daily Warehouse Report yourself, registered versus eligible inventory, what each category means, and why the ratio between them is the number most retail investors never look at but should. That is a skill worth having. And if someone in your life is watching the silver market right now and feeling like the price does not reflect what the fundamentals are saying, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.